If you or someone you love receives Social Security benefits, or if you are planning for retirement and counting on those monthly payments, then what I'm about to share with you today is absolutely critical, because right now in 2026, a series of major rule changes from the Social Security Administration are already in effect, and millions of seniors and retirees across this country either do not know about them or have not yet taken the steps they need to take to make sure they are getting every single dollar they deserve. I want to make sure you are not one of those people. My name is Artur, your host, here at Immigration News Today, and today we are breaking down everything you need to know about the SSA 2026 rule changes that are going into effect right now. We are talking about benefit increases, new earnings limits, a landmark legislative change that is still sending retroactive payments to millions of Americans, a brand new tax deduction for seniors, and a major deadline coming up in just days that could affect your Medicare coverage. Stay with me, because by the end of this video, you will know exactly what has changed, how it affects you personally, and what actions you need to take right now. Let us start with the foundation, because to understand why these changes matter, it helps to understand how Social Security works and why it touches so many lives. Social Security is not just a retirement program. It is a safety net that covers retired workers, people living with disabilities, surviving spouses, and in some cases, dependent family members. According to the Social Security Administration, tens of millions of Americans receive some form of Social Security benefit every single month. For many seniors, this is not supplemental income. It is their primary or even sole source of financial support. So, when the SSA makes changes, the ripple effects are enormous. And in 2026, those changes are significant. The first, and perhaps most immediately noticeable change for most beneficiaries, is the cost of living adjustment, which everyone in the Social Security world simply calls the COLA. Every year, the SSA evaluates inflation data and adjusts benefit amounts to help recipients keep pace with rising costs. For 2026, the COLA has been set at 2.8%. That is up from 2.5% in 2025. In real dollar terms, according to the SSA's own published figures, the average retirement benefit will rise by approximately $56 per month, bringing the average monthly check from about $2,015 in 2025 to about $2,071 in 2026. For married couples where both spouses receive benefits, the average increase works out to about $88 more per month, bringing their combined average to around $3.8. Now, I want to be honest with you here, because I respect your intelligence and your time. A 2.8% increase sounds good, and it is certainly better than nothing. But many seniors and advocacy organizations, including AARP, have pointed out that this increase may not fully offset the rising costs that retirees face, particularly in areas like healthcare, housing, and prescription drugs. An AARP survey conducted in late 2025 found that a significant majority of older adults felt even a 3% COLA would not be enough to keep up with their actual expenses. So, while your check is going up, it is important to review your full budget picture and not assume the increase will cover every gap you may be experiencing. Now, here is where things get very important and where a lot of people get confused. Let us talk about the earnings test. If you are receiving Social Security retirement benefits and you are still working, you need to pay close attention to this. The SSA applies what is known as an earnings test to beneficiaries who claim Social Security before reaching what is called their full retirement age, or FRA. Your full retirement age is the age at which you are entitled to receive your full unreduced benefit. And in 2026, this is a milestone year, because for everyone born in 1960 or later, the full retirement age is now officially 67. This is the completion of a decades-long gradual increase in the FRA that Congress put into motion back in 1983 with amendments to the Social Security Act. For those individuals born in 1960 who are now turning 66 this year, reaching age 67 in November 2026 will officially complete that transition. So, what does the earnings test actually mean? If you are collecting Social Security retirement benefits but have not yet reached your full retirement age, and you are also earning income from a job, the SSA will reduce your benefits if your earnings exceed a certain annual limit. In 2026, that limit is $24,180 for people who will not reach their full retirement age at any point during this calendar year. If you earn more than that, the SSA will withhold $1 in benefits for every $2 you earn above that threshold. If you will reach your full retirement age this year, the limit is much higher at $65,160, and the withholding rate drops to $1 for every $3 earned above that amount. Once you have fully reached your full retirement age, the earnings test disappears entirely, meaning you can earn as much as you want from work without any impact on your Social Security benefit whatsoever. Here's the part that trips a lot of people up, and I really want you to hear this clearly. This earnings test is not a tax and it is not a permanent loss of money. It is a temporary withholding. What the SSA is doing is deferring those withheld dollars. Once you reach full retirement age, the SSA recalculates your monthly benefit and gives you credit for those withheld amounts by increasing your monthly payment going forward. So, you are not losing that money forever. You are simply receiving it later and in a different form. That said, the mechanics can still be confusing in the short term, especially if you are budgeting month to month. So, understanding this rule before you claim early is absolutely essential. Now let us talk about one of the biggest and most important changes that has happened to Social Security in decades. And this is one that I know many of you watching today have been waiting to hear about. I am talking about the Social Security Fairness Act, which was signed into law on January 5, 2025 by the outgoing administration. This law eliminated two provisions that had quietly and significantly reduced Social Security benefits for millions of public sector workers for decades. Those provisions were the windfall elimination provision, known as WEP, and the government pension offset, known as GO. Here is what those provisions did. If you worked in a government job, a public school, a state or local agency, or in certain public safety roles, and your position did not pay into Social Security, but you also had some Social Security covered work during your career, the WEP would reduce your Social Security retirement or disability benefit. The GO, on the other hand, reduced or even eliminated spousal and survivor Social Security benefits for people who received a pension from non-Social Security covered government employment. For many retirees, these reductions were severe. Some people saw their Social Security benefit cut by hundreds of dollars a month. Surviving spouses of public sector workers sometimes saw their entire spousal benefit wiped out. With the signing of the Social Security Fairness Act, both of these provisions are gone, permanently eliminated. As of early 2026, the SSA has already paid out approximately $17 billion in retroactive payments to roughly 3.1 million beneficiaries who were affected by WEP and GO. For many of those people, those payments showed up as a lump sum in their accounts, and their monthly benefits have been recalculated and increased going forward. But here's the critical warning I have to give you, because not everyone who is entitled to these payments has received them yet. If you are a retired public sector worker who was subject to WEP or GO, or if you are a surviving or divorced spouse of someone who worked in a non-Social Security covered government job, you need to log into your My Social Security account at SSA.gov right now and check your benefit amount. Compare what you are receiving today against what you were receiving before January 2025. If your monthly amount has not increased and you believe you were affected by WEP or GO, you need to contact the SSA directly. Senators from both parties have already written to the SSA urging them to process maximum retroactive payments to all eligible spouses and to prioritize remaining cases. The process is ongoing and not yet complete for everyone. This is not a situation where you should sit and wait passively. If you or a family member worked in government, education, public safety, or another non-Social Security covered public position, take action. Go to SSA.gov, log in, or create a My Social Security account. Review your benefit history. And if something looks off, pick up the phone and call the SSA, or go to your local SSA office. You may have money coming to you that has not arrived yet. Now let us shift to something that is going to be very welcome news for many seniors watching today. I am talking about a new tax benefit called the Senior Bonus Deduction, which was introduced as part of the legislation informally known as the One Big Beautiful Bill Act. Here is what it means for you. For tax years 2025 through 2028, Americans who are 65 years of age or older may claim an additional $6,000 deduction on their federal tax return. If you are married and filing jointly and both spouses are 65 or older, that deduction doubles to $12,000. This is separate from and in addition to the standard deduction and the existing additional standard deduction that seniors already receive. The IRS has confirmed this deduction is available to eligible seniors, and you do not need to itemize your taxes to claim it. Why does this matter for Social Security beneficiaries specifically? Because part of what determines whether your Social Security benefits are taxable at the federal level is your combined income, which is a calculation that includes not just your wages, but also certain investment income and a portion of your Social Security benefits. The higher that combined income, the more of your Social Security benefit becomes subject to federal tax. By allowing seniors to claim this additional $6,000 deduction, many retirees who were previously just over the taxable threshold may now find themselves back below it, meaning more of their Social Security income stays in their pocket. If you are not sure how this deduction applies to your specific situation, this is a conversation worth having with a tax professional or a qualified financial advisor. Speaking of taxes, here is another change that will benefit some viewers directly. The state of West Virginia has now completed its phase out of state-level taxation on Social Security benefits. As of 2026, West Virginia residents who receive Social Security no longer owe state tax on those benefits. That brings the total number of states that do not tax Social Security to 42. If you live in one of the remaining 8 states that still tax Social Security at the state level, it may be worth reviewing your state's specific rules and thresholds, as some states offer partial exemptions or credits based on income level. Now, let me take a moment to talk about a few other technical updates from the SSA that are in effect this year. The maximum amount of earnings subject to the Social Security payroll tax, called the taxable earnings cap, has risen to $184,500 in 2026, up from $176,100 in 2025. This primarily affects higher-earning workers who are still paying into the system. The credit threshold has also changed. In 2026, you earn 1 Social Security work credit for every $1,190 in wages or self-employment income. You need 40 credits total to qualify for retirement benefits, and you can earn a maximum of 4 credits per year. This threshold goes up slightly each year. So, if you are a part-time worker or someone with gaps in your employment history, keep track of where you stand. And for those receiving Social Security Disability Insurance, known as SSDI, the Substantial Gainful Activity Limit, which is the amount you can earn without risking your disability benefits, has increased to $1,690 per month for most beneficiaries and to $2,830 per month for those whose disability is blindness. Now, I want to talk about something that has a deadline coming up in just days, and if you have Medicare Advantage coverage, you absolutely cannot afford to miss this. As of the filming of this video, March 31st, 2026 is the last day of the Medicare Advantage open enrollment period. What that means is that if you are currently enrolled in a Medicare Advantage plan and it is not working for you, whether because your doctor left the network, your drug formulary changed, your premiums jumped, or you are simply not satisfied with your coverage, you have until March 31 to switch to a different Medicare Advantage plan or to return to original Medicare, which is Parts A and B, with or without a separate Part D prescription drug plan. After March 31, you are locked into whatever plan you are in until the next open enrollment period, which does not open again until October. So, if your current Medicare coverage is not meeting your needs, do not wait. Go to Medicare.gov, use the plan comparison tool, call 1-800-MEDICARE, or speak with a state health insurance assistance program counselor in your area. This deadline is real and it matters. Let me also mention one legislative development that is still in motion and that many seniors and immigration-connected viewers are watching closely. There is a bill in Congress called the You Earned It, You Keep It Act. If passed, this legislation would eliminate federal income taxes on Social Security benefits entirely for most recipients, beginning with tax returns filed in 2027. As of today, that bill has not yet been signed into law and remains pending in Congress. It would represent an enormous financial relief for many retirees if it passes. So, it is worth watching. We will continue to cover it here on Immigration News Today as it develops. Before I wrap up today, I want to speak directly to those of you who immigrated to this country, who became naturalized citizens, or who are lawful permanent residents working toward retirement. Social Security is a system you paid into just like every other worker. Your contributions count, your credits count, and these rule changes apply to you as well. If you have questions about how your work history, any time spent outside the United States, or your immigration history may affect your Social Security eligibility or benefit calculation, the SSA has multilingual resources available at SSA.gov and at local SSA offices. Do not let language or unfamiliarity with the system keep you from claiming what you have earned. Here is a quick summary of the actions I want every viewer to take after watching this video. First, log into your My Social Security account at SSA.gov and review your current benefit amount and your earnings history. If you are a current or former public sector worker who is subject to WP or GO, confirm that your benefit has been updated following the Social Security Fairness Act. If it is not, contact the SSA. Second, if you are 65 or older, ask your tax professional about the new $6,000 senior bonus deduction when filing your 2025 federal return. Third, if you are still working and collecting Social Security before full retirement age, make sure your earnings for 2026 are on track to stay below the appropriate earnings test threshold of $24,480 or $65,160, depending on whether you reach your FRA this year. Fourth, if you have Medicare Advantage coverage and are not satisfied with your plan, act before March 31st, 2026. And fifth, keep watching official SSA communications through your My Social Security account and stay connected here with us for ongoing updates. As a reminder, immigration policy and Social Security rules can change. The information I have shared today reflects what is known and verified as of March 24, 2026, based on official SSA publications, IRS guidance, and reporting from credible outlets including Kiplinger, the MLI Fool, and AARP. This content is for formational purposes only and is not a substitute for personalized legal or financial advice. For your specific situation, please consult a qualified Social Security attorney, a certified financial planner, or contact the SSA directly at ssa.gov or by calling 1-800-772-1213. We created Immigration News Today because we believe every person, whether you came to this country decades ago or recently, whether you were born here or naturalized, deserves access to clear, accurate, and timely information about the systems and rules that affect your life. Social Security is one of those systems, and today's changes are real. They are significant, and they deserve your attention. If this video helped you or someone you know, please like it and share it with a family member, a neighbor, or a friend who may need this information. Subscribe so you never miss a critical update. Check our video description for links to official SSA and IRS resources. And as always, take care of yourselves, take care of each other, and we will see you in the next